Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 14, 2024. We're looking at a daily chart of the SPY or spiders, which is the proxy for the S&P 500. What do we have on the docket today? We left the blue dotted line on the screen from last night because it represents the 618 retrace, the 61.8% retrace from the all-time high to the most recent low, and the market today achieved that specific retracement, retracing 61.8% of that particular move. So, where do we go from here? Can the market go higher? Of course the market can go higher. The question is, will they jam them up into the end of options expiration week? This is regular way options expiration week. Or will they have a pullback into the end of options expiration week? One thing we must note, above all the moving averages, the trend is what? She is your friend. Repeat after me. Above all the moving averages, the trend is your friend until she throws your stuff out the window, meaning until the trend is over. Technically, on the weekly chart, never broke trend. Even though above all the moving averages, the trend is your friend, certainly an uptrend, but on the weekly chart from a long-term perspective, above the 50-period moving average is still an uptrend. So when you look at this from a very, very long-term perspective, staying above the 50-period moving average is essentially where the money managers want to see the market. Below the 50-period moving average on the weekly chart, they begin to get nervous. So you don't have to be above the 20. They don't care about the 20. It's a little fast moving for a money manager. They're concerned with the 50. So investing public is the 50-period moving average weekly chart. That maintains the uptrend. Might want to jot that down, put it on a sticky note. As far as the daily is concerned, they filled the gap that was left open. They got to the 618 retracement. You have an 8-day move. You make it 10 if they go into Thursday, Friday with more upside / non-downward activity. That'll be a 10-day move from the low through the end of options expiration, regular way options expiration. So these are the things that I'm thinking about. These are the things on my mind. We don't know exactly what's going to happen. Our job is to put the pieces to the puzzle on the table, and we start assembling the pieces to come out with the picture of what the next likely highest probability scenario is with the market. There's another thing that's food for thought. Another thing you might want to jot down, take a snapshot of, write it down as sticky notes. Here's a trend line that connects the high versus, or not versus, but to this pivot comes from the 1st of August. And you can see where we are just above the 618 retrace, but not that far away from today's high. So another update or two may run into that trend line. That is bona fide overhead resistance. The 618, the trend line, time. Time is more important than price. Remember what we talked about a couple of days ago? We said, look, the job of the market, not only is to make as many traders and investors look like fools as much of the time as possible, but part of the job is to make you believe, you generically, you as a trader, me, you, everybody else, cousin Jimmy, everybody, make us believe that the correction is over before the next leg down ensues. That's part of that wave 2 thing and what we discussed. And I don't use Elliott wave a lot, but everybody can see that this is at some degree a wave 1 down. Whether it's at a major, minor, intermediate degree, it doesn't matter. This is a wave 1 down. This is an A wave down. What this is leading to a bounce in a 2 wave. This is, at least in my opinion, and some of the psychological characteristics of a second wave is to make you believe, you, me, you, cousin Jimmy, everybody believe that the correction is over and a new leg higher is ensuing, and that's designed to happen right before or right around the time that they decide to pull the rug out for the next wave or leg lower. Just a little Elliott wave tidbit. You know, I don't hold a lot of stock in Elliott wave. I think it's a great after-the-fact labeling mechanism, but from a trading and investing standpoint, unless you can identify a third of a third of a third, you're probably going to be wrong in your count. There's too many counts. There's too many alternates. You ask 10 Elliott wave statisticians, whatever they are, ask 10 Elliott wavers what the count is. You get about 18 different counts with 22 alternates. How useful is that? What's going on inside the numbers today? What was the deal there? Did we have a trade on the board? Well, I can tell you up front, we're going to highlight the important stuff, and I can highlight the really important stuff was we had a trade at the pivot. It was the test the pivot, bounce back in the other direction trade. It's one of our small bucketfuls of trades in the live room in the morning, that repeat, called the morning trade, if you will, that repeat over and over and over again. There's a handful of types of trades, just like there's a handful of types of swing trades that I prefer that are programmed into the Lazy Swing Trader Automagical Algo system. Well, there's a handful of day trades, scalp trades with potential that we take in the live room in the morning that we like to see. One of them was case in point today, the run a test of the pivot, bounce back in the other direction trade. Remember, pause the video, read the notes, go back to the chart and double check the work. So we had an 8:30 a.m. economic data release. What they did was they filled the gap up north, 543.04. They backed off of it in the pre-market, but will technically need to do it again during the pit session. So we know that place is important, 543.04. Here's a 5-minute chart. Right of the vertical is today's activity, and you can see right here, 543.04. That's the official filling of the gap. They spiked it, did the 618 retracement, and then backed off of that area. Normal garden variety market behavior. But wait, there's more. We'll get to some other numbers in a moment. You're going to see 544.20 pop up. That was the 618 retracement. We had some stuff above that. We don't have to worry about that right now. Here's where we're focused on. 540.80 is support and our early pivot. Remember, the pivot trade. Test the pivot, bounce them back in the other direction. 540.80. Here it is. You can see here they came up 4 cents short. Traders got a scalp out of this in the live room. Some picked it up in front of it. We don't split hairs over pennies. Trader's choice. Then they came into it and then they ripped them back up and went to the gap and the 618 retracement. 540.80 was in fact our pivot. If you're actively trading in the S&P during the trading day, this is information that need to know. You need to know. Do you know where the pivot is each and every day? If you do, great. If you don't, why not? Then you need to come over and find out where the pivot is. All provided before the opening bell. That was at 9 a.m. Eastern Standard Time. Pause the video. It's all in here. All the rest is in here. I highlighted the important stuff. The trade was long at the pivot. Here's 934. 540.80 is the pivot and an area they should bounce the tape, give or take if reached sooner than later. They did that. Pause the video, read the notes, go back to the chart to double check the work. It's all in here. Everything you need to be successful in trading the S&P, the SPY, futures, ES, micros, options on the SPY, options on futures, the exchange-traded products, triples, doubles, singles. It doesn't matter. It's all directional trading stuff. We only had 2 stocks on the move potentials today. We'll take a look at TJX and EAT, which is Brinker International. You could see TJX companies, 108.47. Unfortunately, they opened below the first number, above the second, never got to the second. It was about $1 or so under, and then they ripped it back up in the other direction. So painting by the numbers, the manner in which applies, the numbers work, only it was just a little bit of a shenanigan screw job in opening below the number. 108.47 was today's number in TJX. How about Brinker? How you doing? 59.10. Came up just a few pennies short. Couple minutes later, spiked it, ripped it back up in the other direction. From 59.10 all the way up to around 63.5. That's one hell of a day trade when you actually do the math. Once again, for the most part, nailed low of day. Dead low, as they say in the trading parlance. What's going on over in Camp IWM? Well, interestingly enough, my favorite market leading indicator down 0.6% today, while the spiders were up 1/3%. So here's a divergence. You could see essentially getting rejected at or can't get through yet. Either way, it depends on whether you want to be half glass full or half glass empty, but can't yet get through the 50-period moving average. Had a down day. Favorite market leading indicator, but as you'll see, the folks down at the transportation department were flat today. IWM was down, S&P was up. Divergences will resolve themselves. Either the S&P is going to roll over a little bit and follow suit with the folks down at the IWM department, or Camp IWM, I should say, or the IWM is going to pick right back up and pop over the 50-period moving average and go fill that gap that is left unfilled. So if you just look at this objectively, the gap is 208.92. Today's high is 208.75. So they've come up short of the gap. They have not filled the gap. Chances are, now it's not a guarantee, chances are they go get the gap. Chances are this is just a fake out shenanigan type of routine, trying to suck traders into the short side, give them a pie in the face, all that stuff. What about the folks down at the transportation department? Still stuck around the convergence of those moving averages. You have the 100, the 200, and the 50-period moving average. You have this rally off the low, but they haven't really got very far. They got, after the first day, they got up to here, and they basically gone sideways since. You got to put that in perspective. That is relative weakness from a chart perspective, a performance perspective. The transports against the SPY. Let's bring up the SPX. You can see this straight line up, other than a one-day wonder down. But just look at this for what it is. Straight line up, and you have the transports. They're up here the next day, but they've just gone sideways. So is this a sideways move, building energy for another move up? Or is this so weak that they're just going to roll over again? Again, we don't know the exact answer, but these are the things as an analyst, that you need to be, I need to be contemplating, looking at, taking into account. These are puzzle pieces. These are the puzzle pieces on my table. Qs look more similar to the S&P 500 in terms of off the low. They're still below the 50-period moving average on the daily chart, but they're ahead of the power curve, if you will, relative strength off the bottom against the S&P. Yesterday filled the gap that was filled in the S&P today. This gap over here, yesterday got above the 20-period moving average, stayed above today. Same routine for the S&P, but we'll see if they can head to the 50-period moving average, coinciding with what? Well, this is a big-time breakdown candle high. Coinciding with the 50-period moving average on the daily chart. Coinciding with the neighborhood of the 618 retracement that the S&P had already run to. So you see here, they're not really ahead of the power curve against the S&P. I'm going to take that back real quick. But if they were to match and get up to the 618, that's an interesting spot. If they did that, where does that put the S&P at the same point in time? Well, a lot higher than they are now. That's what that does. So you're actually in a lagging situation in the Qs against the S&P. Nice big day upward, up over 1%, about 1.25% for the financial department today. If the financials aren't falling apart, is it unlikely the rest of the market's going to fall apart? And the answer is no, probably not. If you're wondering, gap up here is 43.12. Today's high, 43.13. Filled the gap, backed off a little bit. Any accidents or coincidences? I think not. That is absolutely because that's what they wanted to do today. Above all the moving averages, the trend is in fact your friend, her friend, cousin Jimmy's friend. Smash mouth, flat today, up 20 cents. That's flat. Flat as a pancake. Run into the 100 period moving average, backed off a little bit, sandwiched in between the 100 and the 20. We're not going to make heads or tails or a federal case out of that one. All we're going to say is look similar to the spiders, similar to the Qs. They're either going to continue up and get above or to this breakdown candle high, or they're going to start retracing back down. There is a steep trend line that smash mouth, or the Philadelphia Semiconductor Index, is above right now. Got above it yesterday and keep going. This is a little steep, but it is a trend line nonetheless. So we're not going to say it doesn't count because it's a little steep. We're going to say that's a trend line that they broke out above. Period. Full stop. That's the bull case. When analyzing any chart, you must be the umpire calling balls and strikes. You cannot show up to the chart with a bias in one direction or another. Each chart is independent of one another, but all charts act and react the same way. And I teach that emphatically in my course, Lazy E-mini Trader. And that's where we're going to leave it tonight. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.